What happens when a company bets its balance sheet on Bitcoin and the price gets cut in half overnight? The answer isn't about conviction or belief, it's about the fine print nobody reads until it's too late. Let's talk about debt structure, because not all corporate debt is created equal. And the difference between surviving a crash and being forced to sell at the worst possible moment comes down to three things: maturity dates, interest rate type, and whether your Bitcoin is sitting in a vault or being used as collateral. Think of it like renting versus owning. One lets you ride out a storm, the other puts your landlord in control of the thermostat. If a company holds long-term, fixed-rate, unsecured debt, they essentially bought themselves time and breathing room, because nobody can come knocking and demand their Bitcoin back regardless of price. But the moment that debt becomes short-term or variable rate, the company is now playing a game where the rules can change mid-play, and the house almost always wins. Here's where it gets surgical. Secured debt, specifically debt that uses Bitcoin as collateral, introduces something called maintenance margin requirements. And this is the mechanism that turns a market dip into a forced liquidation event. Imagine you borrowed money and put your Bitcoin up as the guarantee. Now imagine the lender has written into the contract that if your collateral value drops below a certain threshold, they get to sell it immediately without asking you. That clause is called a margin call trigger. And it's the financial equivalent of a trapdoor. Everything looks fine until it absolutely isn't. When Bitcoin dropped from $69,000 to $15,000 in 2022, companies like Celsius and Voyager weren't just victims of market sentiment. They were victims of their own debt architecture. Covenant breaches are the slightly quieter but equally dangerous cousin of margin calls, because lenders often write debt covenants that tie your borrowing limits to the value of your assets, meaning if Bitcoin falls, your borrowing capacity shrinks automatically, and you may suddenly be in technical default without missing a single payment. It's like your credit card limit getting cut in half because your portfolio went down, except now you owe fees, penalties, and possibly the entire balance immediately. Acceleration clauses are the final boss in this hierarchy of pain, because they allow a lender to demand full repayment of the entire loan the moment a covenant is breached or a trigger is hit. Not next quarter, not on the original schedule, right now. So what starts as a 30% Bitcoin correction can cascade into a company needing to liquidate hundreds of millions of dollars in Bitcoin within days, which then pressures the price further, which then triggers other companies' covenants. And suddenly you have a contagion spiral dressed up as a market correction. History has shown us this pattern repeatedly, from the gold-backed margin calls of the 1930s, to the mortgage-backed securities collapse of 2008, to the crypto credit crisis of 2022. The asset class changes, but the contractual mechanics stay hauntingly familiar. The lesson isn't that debt is evil. The lesson is that secured, short-term, variable rate debt tied to a volatile asset is essentially a loaded weapon pointed at your own balance sheet. A common misconception is that if a company believes in Bitcoin long-term, they'll never be forced to sell. But belief doesn't override legal obligation. And a margin call doesn't care about your investment thesis. The lender's contract supersedes the CEO's conviction every single time, which is why sophisticated corporate treasurers should be interrogating debt terms with the same intensity they apply to the asset itself. So, what's the practical takeaway here? When evaluating any company holding Bitcoin on its balance sheet, whether you're an investor, a counterparty, or just curious, ask 4 specific questions. What is the maturity date of their debt? Is the interest rate fixed or floating? Is the debt secured or unsecured? And does any covenant tie their borrowing capacity to asset valuations? Those 4 answers will tell you more about their crash resilience than any press release ever will. The companies that survive Bitcoin downturns aren't always the ones with the most Bitcoin. They're the ones with the cleanest, most patient debt structures, because patience embedded in contracts is more powerful than patience as a personal virtue. MicroStrategy, for example, has survived multiple severe corrections, largely because they've been deliberate about issuing long-dated, unsecured convertible notes that give them years of runway, regardless of price action. Position sizing and structural discipline matter infinitely more than timing. And the same logic applies to individual investors. Building exposure to volatile assets, your ability to hold through pain is only as strong as your financial structure allows it to be. Conviction without liquidity is just optimism with a countdown timer. At the end of the day, markets are emotional, but contracts are mechanical. And understanding the mechanical layer underneath the narrative layer is what separates investors who get carried out from those who carry the bags all the way to the other side. Discipline, structure, and sizing, those are the only three variables fully within your control in a world where everything else is noise. Whether Bitcoin goes to $200,000 or back to $20,000, the companies and individuals who prepared rationally, structured their exposure honestly, and sized their risk appropriately will wake up the next morning with options. And that's all preparation is really about. If you're ready to build that kind of structural foundation in your own financial life, whether through real estate investing, home contracting work, or finding the right lenders, check out our links in the description below.